Hello, Dr. Dolly. My name is Dean from the Upper Midwest. My question is regarding the consequences of tax loss harvesting. I understand the immediate benefits for the tax year of taking a capital loss. However, by taking a capital loss now, aren't we, as a result, in a way, lowering our cost basis for the future and thereby setting ourselves up for more capital gains down the road? So I guess is the rationale that long-term capital gains might be realized perhaps at a lower percentage with lower income in retirement? Or is it that capital gains might be wiped out when inherited by my eventual beneficiaries upon my death? I just want to understand if tax loss harvesting is really all that it is cracked up to be, or am I thinking about this in a wrong way? And by the way, I get the sense that you are generally humble in praise that is given to you, but honestly, I think that you have been a catalyst in revolutionizing how doctors and other high-income earners handle their money and think about their money, really in a positive way, breaking preconceived notions of what doctors are supposed to do with their money. And for that, really a big thank you, and I think I can speak on behalf of many of us.
All right, let's talk about tax loss harvesting. This is a really important subject. I actually named the podcast after this one. If you've been hemorrhaging money in the markets like most of us, you may want to do some tax loss harvesting. This is a great way in which you can get Uncle Sam to share the pain of your losses. Now, remember, it does not work in retirement accounts. You can't do this in your 401k or your 403b or your cash balance plan or your Roth IRA. This is only in a taxable or a non-qualified or brokerage account. So make sure if you're going to do it, that you're only doing it in that account. And what you most need to be careful of when tax loss harvesting is avoiding a wash sale. So that is when you buy something, or rather when you sell something, and then you buy it within 30 days, either before or after the date you sell it. If you do that, it's a wash sale and you cannot use that tax loss. So why is a tax loss useful? Well, you can take up to $3,000 per year in capital losses and offset your ordinary income with that loss. So it actually lowers your tax bill. Any other losses are placed against your capital gains. So you can use them in any limit, not just $3,000 a year, but hundreds of thousands of dollars a year if you want, toward any capital gains taxes you owe, whether those are capital gains on a property that you sell or a small business you sell or or a mutual fund that you sell for gains now or later in life. So there's a lot of benefit there in that you can use this to lower your taxes. And if you don't use all of the losses in 1 year, you get to carry them forward. And you can carry them forward for years and years and years and years. Now, thanks to this recent bear market, I now have hundreds of thousands of dollars in tax losses. So obviously, if I was only able to use $3,000 a year, I've got more than enough to last the rest of my life. But I fully expect to be able to use it to offset other things, including being able to spend from that taxable account totally tax-free in retirement, for instance, or just simply being able to reposition a portfolio without having to worry about the capital gains taxes that are due. Now, it is true that in a lot of ways, you are just deferring tax. Not that there isn't any value to that. There is value in paying tax in 20 years instead of paying it now. But if you tax loss harvest, you are lowering the basis on the investment and will owe more in taxes later when you sell it. However, there are a couple of ways in which that's helpful. First of all, you get to delay the taxes, which is not as good as avoiding them completely, but is better than nothing. It is not the same thing to have to pay taxes now versus paying taxes later. Second, if you give anything to charity, instead of giving cash, you could give appreciated shares and then flush those gains right out of your portfolio. This is what I do every year. I tax loss harvest the losses, and when I have shares that have appreciated, when I've held them for at least a year, and I have a positive gain in them, I use those for my charitable contributions. And you can do that either through a donor-advised fund, or you can give it directly to the charity so long as they have a brokerage account and they can handle that sort of a contribution. If you do that, you get the full deduction for the entire contribution off your taxes when you itemize, right? It's a charitable contribution, but you don't pay the capital gains taxes and neither does the charity. It's really a great deal. So you get the tax loss, you don't pay the gains. So that's one way in which you don't pay it at all, and tax loss harvesting can be really, really valuable. The second way is if you die. When you die, your heirs get a step up in basis at death. So their basis is essentially whatever it was worth when you died. And so if you have a really low basis because you did a bunch of tax loss harvesting, that's okay because nobody ever pays those gains back. So in those situations, it really can be super beneficial to tax loss harvest. But even if you end up selling those shares later and paying those capital gains, just deferring it is helpful. And of course, you can take $3,000 of it each year against your ordinary income, and that's helpful as well. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.